Treasury yields spike, threatening retirement savings and mortgages. This might cause concern about its effects on your retirement savings or mortgage payments. However, it's important to remember that over the long term, historically stable investments like index funds often outperform more volatile options. Let's start with the basics. Treasury yields are the interest rates that the U.S. government pays to borrow money through the issuance of debt securities like bonds. Currently, these yields are increasing rapidly, and understanding their implications is crucial for investors and the broader economy. First off, let's talk about why Treasury yields matter to your wallet. When these rates rise, bond prices fall because the higher yield of new bonds makes existing ones less attractive. That means if you own bonds in your investment portfolio, their market value is dropping. This isn't a good thing for investors who are counting on those bonds for stable income from capital gains or selling them at par, but it can be an opportunity to reinvest at higher rates. But here's the real question: what does this mean for your savings and investments over the long haul? When Treasury yields rise, it often signals that investors are concerned about economic growth or inflation expectations. That means other assets like stocks might become more volatile as well, potentially affecting the value of your 401k or other investment portfolios. Let's look at an example. Imagine you're planning to retire in 10 years and have invested heavily in bonds for their stability. If Treasury yields rise significantly, the market value of your existing bond portfolio will decrease because rising interest rates make newer bonds more attractive due to higher yields. This decline isn't what you want as you head into retirement. Now let's dive deeper. Why are these yields rising now? Usually it's because investors expect higher inflation or economic growth. However, it can also be due to global events like a recession in Europe or China. When markets become uncertain, they often favor the safety of government bonds, which drives up their prices and initially lowers yields. But when those concerns ease, yields tend to climb again as bond prices fall. So what should you consider? One option is to maintain a conservative portfolio with low-yielding yet stable assets. Another is to pursue higher returns through riskier investments like stocks or real estate. However, history shows that the safer choice often provides more consistent long-term benefits. Let's break it down. When Treasury yields rise, many investors often move into high-risk stocks in search of higher returns. However, those who maintain stable bonds usually fare better over the long term. Why? Because as bond prices fall initially due to rising yields, they become more attractive for purchase at lower price points. As you hold these bonds until maturity, their fixed interest payments offer steady income and eventual capital appreciation if held to maturity, providing a solid return. Think about it this way. Imagine you're at a casino betting on red or black in roulette. Everyone's excited because red just hit 5 times in a row, so they think it's due for another win. But statistically, each spin is independent and has an equal chance of landing on either color. The excitement causes people to bet more, but the odds remain unchanged. When Treasury yields rise sharply, some investors become anxious and may sell bonds to buy stocks. However, this can lead to short-term volatility. Over the long term, sticking to a well-diversified investment strategy and avoiding emotional decision-making typically benefits investors more than reacting to market fluctuations. So here's your takeaway. When Treasury yields rise sharply, it might feel like you need to react quickly. But in reality, maintaining composure and adhering to your investment strategy can often be more beneficial than making hasty changes at the first sign of market turbulence. Let's get concrete now. Imagine you have $100,000 invested in a mix of bonds and stocks. If Treasury yields spike significantly, say by 2 percentage points overnight, your bond portfolio might lose about 5 to 8% of its value immediately due to the inverse relationship between bond prices and yields. However, if you panic sell at that moment, you could lock in those losses. Now let's look at the conservative option, holding steady and riding out any volatility. Over time, as yields stabilize and bond prices adjust, you can start to see bond performance improve again, potentially offering decent returns without taking on additional risk. Let's dive deeper into some numbers. Say your bond portfolio had an average yield of 2% before the spike. If Treasury yields rise by another percentage point to 3%, it initially knocks down the value of your bonds, but over 5 years, they can still deliver decent returns if you hold them and reinvest the coupons at the higher rate. Now let's compare this to chasing higher returns in stocks. When Treasury yields rise sharply, it can lead to a decline in stock prices as investors may shift their focus from equities to fixed income securities, which offer relatively better returns at higher yield levels. So even though high-yield investments might seem attractive, the risk is much greater. You could end up losing more than you gain by jumping into volatile markets, where prices can fluctuate significantly. Here's a quick recap. When treasury yields rise suddenly, it's easy to feel like you need to act fast. But history shows that sticking with stable assets and riding out short-term volatility often leads to better long-term results compared to risky moves fueled by fear or excitement. But there's more to the story. Let's explore why this happens. When investors observe treasury yields rising, they may consider alternative investments such as high-yield bonds or emerging market stocks. While these options might offer potentially higher returns, they also come with significantly greater risk of loss during market downturns. So instead of chasing these shiny objects, you're better off sticking to your diversified portfolio, which includes a mix of safe assets like bonds and cash alongside moderate risk investments, while also ensuring that you have a solid emergency fund. Now let's look at an example from the past. In 1981, when treasury yields spiked dramatically due to high inflation, investors who panicked and shifted into risky stocks often ended up worse off than those who stayed calm and held onto their bonds. Over 10 years, bond portfolios generally provided more consistent returns compared to volatile stock picks, reflecting the importance of maintaining a balanced approach during periods of economic uncertainty. This isn't just about avoiding losses. It's also about preserving your purchasing power for future needs like retirement or significant purchases. By adhering to a disciplined investment strategy when yields increase, you maximize your chances of achieving long-term financial goals while managing risk effectively. Now let's circle back. What should you do if treasury yields are currently rising? First and foremost, don't panic sell. Staying calm is crucial. Review your portfolio to ensure it remains well diversified with a mix of safe assets like bonds, balanced by moderate risk investments for growth potential. Think about this question now. How much would it cost you in fees to rebalance your portfolio every time treasury yields spike? Fees can be a big hidden drag on your returns over the long run. Even a small fee of 0.1% annually adds up significantly, potentially costing you thousands or even tens of thousands of dollars over decades due to the power of compounding. Here's another concrete example. If you have $200,000 in a retirement account with an annual management fee of 1%, that fee alone could cost you approximately $20,000 over 10 years without any investment gains or losses. If treasury yields rise and you rebalance frequently due to fear, those fees compound further, eating away at your savings. Subject: soaring treasury yields and their long-term financial implications. Passage to fact check. So let's summarize. When treasury yields rise, avoid the temptation to chase higher returns in risky assets. Stay calm, stick with a diversified portfolio, and resist the urge to make frequent changes driven by short-term market movements. Keep in mind that diversification helps spread risk across various asset classes, potentially reducing the impact of volatility on your overall investment performance. But what if you're thinking about buying more bonds now that yields are high? This can be tempting because it seems like a good time to lock in higher rates. But beware, buying into a rising rate environment means bond prices will likely fall, eroding any capital gains quickly. So if you do decide to buy, make sure it's part of a long-term strategy rather than an emotional response. Now let's wrap up by looking at what history teaches us about treasury yields and investor behavior. When yields rise sharply, many investors tend to overreact and frequently change their investment strategies, which can lead to higher fees and missed market opportunities due to selling at lows and buying at highs. But the disciplined approach of holding steady often leads to better outcomes. By remaining patient and avoiding emotional decisions, you provide yourself with the opportunity for solid long-term growth without taking unnecessary risks. So here's your final takeaway. Rising treasury yields might feel like a crisis, but they can be an opportunity to reassess your investment strategy and focus on historically reliable approaches. Stay calm, maintain diversification, and avoid making impulsive decisions when markets become volatile. Now for one last concrete look at what this means in real terms. If you have $100,000 invested today, sticking to a steady portfolio during a spike in treasury yields could help preserve your wealth over the long run by avoiding fees and emotional decisions that can erode your investments. This is educational and historical, not financial advice. Let's zoom in on how fees eat away at your gains over time. Even a tiny 1% annual fee on an investment account can cost you significantly in the long run. For example, if you start with $50,000 and earn an average of 7% annually while paying that 1% fee, after 30 years you'd end up with around $264,690 instead of nearly $386,520 without the fees. That extra cost adds up to about $121,830, which could represent a substantial portion of retirement savings or other financial goals. Another common pitfall is chasing after high-yield investments during volatile times. For example, during the dot-com bubble in 2000, many investors poured money into tech stocks hoping for quick gains, but those who maintained well-diversified portfolios generally fared better over the long term. The seemingly boring option often outperforms the exciting one in the long run. Remember, volatility is just part of the market cycle. When treasury yields rise, it's natural to feel nervous. But if you've built a solid plan based on long-term goals, staying disciplined can help protect your financial future. Think about this. Would you rather have consistent growth over time or experience wild swings that leave you uncertain about your progress? High treasury yields can offer stability but come with their own set of risks and challenges. Stick with it and reap the rewards of patience and consistency. This is educational and historical, not financial advice.